Welcome back. You're watching the first trade, and let's look at what's happening in FNO market with FNO 360 powered by 5paisa.com. Let's start with the Nifty 50. The Nifty is down nearly 0.8%. We're seeing fresh call positions getting added there, and that's putting some pressure. Pushing the Nifty below the 23,700 mark there, with open interest up nearly 1.86. If you look at Nifty Bank, again, the Nifty Bank is down, today roughly around 0.5%, and flattish open interest addition there, but the premium at 168 as we speak. But look at the constituents of the Nifty Bank, and that gives you a good indication of what's happening there. You have short build-up happening in all the private sector banks, which is HDFC, ICICI, Axis. There is a short covering happening in SBI, as a result of which the stock is up nearly 0.3%. But Bank of Baroda, IndusInd, Kotak Mahindra Bank, all are seeing some short positions being built up. Look at the call and put writers, how they are faring at this point in time. A lot of call action happening at 23,700 level, and that's what is pushing the market down. But as we look, if you look at the distribution chart for the May 19 series, you will see that there is still some protection which is there at 23,700. So if the call action continues for some more time, you may see the Nifty drifting below that and staying below that, but otherwise it should come back about the 23,700 mark there. But futures gainers include Oil India, where there's a long build up. ONGC is seeing a long build up, and Hindustan Zinc is seeing a long build up. The stocks up nearly 3 to 7% in today's trade. Among the losers, you have stocks like JSW Energy. There's a short build-up happening, down nearly 5%. Persistent is down 4%. IT index taking a knock today, down nearly 3%. TCS is down 4%, all at 52-week low today. The big boys are at hitting the 52-week low in today's trade there. But open interest gainers will include JSW Energy, short build-up happening, open interest up nearly 11%. Vedanta is seeing some long build-up with 5% jump in open interest, and Keynes Tech is seeing a 3.9% jump in open interest position with some short build-up happening. Among the losers, you have stocks like Blue Star, where there's a short covering happening. ABB is seeing a long unwind, and Adani Power is seeing a long unwind. Most active stock options in today's trade is ONGC 300 call. May call, actually, the premium up nearly 4 rupees to 5.6. There's an unwind of position which is happening. 9.52 lakh contracts are down today, and the stock hovering around the 298.6 mark, up nearly 17.3 in today's trade there. But in the IT pack, Infi is the most active today. Infi 1140 May put is up 18.75 rupees to 31.2. Open interest up nearly 3.35 lakh contracts, and the stock hovering around the 1130 levels as we speak. So market hovering around the 23,636 level as we speak. And we have a management of Indian Hotels also joining us. So Indian Hotels reported a decent set of numbers. Numbers were strong with respect to revenue, growing nearly 14%, profit up nearly 15%, aided by robust room demand. And revenue per average room growth also saw a decent growth. Let's hear out what the management had to say in a conversation with Aisha Faredi.
I think most importantly, we have been communicating and we have been guiding under Accelerate 2030 what we expect. We said it will be double-digit top-line growth. It was double-digit, high double-digit at 16% for the year. The quarter was good because Q4 is always the second best quarter. Q3 is the best quarter for the sector. So Q4 is the second best. Also, we were not as busy in Q4 with the acquisitions as we were in Q2 and Q3. So some of those costs which we had on an extraordinary basis in the acquisitions that we did in Q2, Q3 did not come in Q4. And finally, our not like-for-like growth has been very strong. So hotels take 2 to 3 years to stabilize. And, the year, 2 years ago, we opened 26. Last year, we opened 30. This year, we are going to open 60 new hotels. This is without counting for the inorganic growth. So I think all that on a model which has the right balance between capital light and capital heavy is driving both the operating leverage or maintaining the operating leverage and driving the margin expansion or the margin retention despite this significant amount of growth that we have been having.
But having said that, since you did talk about margins, that's one soft spot in an otherwise very strong quarter, right? It's at 35%, which is a tiny blip of 37 basis points if I just compare on a year-on-year basis. With the revenue growing at 13.7%, investors would have expected better operating leverage. Tell me, where did the cost pressure come from? And is 35% the new floor, or is there a path back to 36% plus levels?
I think it's a very good question. We are not looking exactly at 35.2 or 34.9. What we have been saying consistently is that we have added so many new businesses. We have created almost a new platform which benefits from the core strengths of our traditional business. And then we are leveraging it to grow new businesses. So we have to put in a lot of monies on marketing, on talent, on people, on training to scale up those businesses. So if there is 37 points plus or 37 basis points minus, I think it doesn't matter. The important thing is approximately it is 35 of a top line that is showing significant growth. What used to be let's say 8 years ago, our top line is almost getting close to being our EBITDA going forward. So I think that is the important thing, that we have, removed all the debt. We are cash rich, showing 4,350 crores almost of cash reserves. So I think that are the more important metrics than a little bit percentage point here or there, because we need to scale up the businesses. And in order to scale up without capital investment, you have to put the required power that is needed through other sources.
Puneet, you flagged off the last-minute MICE cancellations, airline route suspensions, impacting the inbound travel and the Dubai hotel occupancy, dropping to about 25%. The revenue growth slowed from 15% in Jan-Feb to about 11% in March. How long does this geopolitical drag last for you? And what's your current read on how Q1 is shaping up, given the conflict hasn't fully resolved?
I think it's been a very challenging, I would say almost 13 and a half months, because last year, April, we had the Pahalgam incident. Then May, we had Operation Sindoor. June, we had the airline thing. And then, it went on with the flooding and unstoppable rains and a further airline challenges that we had in December. So a lot happened on 28th of February, then the West Asia crisis broke out. I think given all that, if a double-digit top-line growth was possible, I think going forward also it should be possible. Important is that the Q3 and Q4 remain intact, because 60% almost of the top line comes in these two quarters. And 40% to 45% is in the first two quarters. April was okay, but May has been off to a very great start. We are seeing very high double-digit growth, and some of the markets have come back very strongly, like Goa. Goa has shown for us in April north of 25% top-line growth, and we wouldn't be surprised if it finished the year as a market on those high numbers.
And now you've got the Prime Minister himself explicitly appealing to the citizens to actually travel only within the country. And I'm sure, you're excited about what kind of a tailwind opportunity this may actually throw up. I know it's very early right now, but assuming this behavioral shift, Puneet, is likely to play out, what sectors, what geographies within your entire portfolio, where do you think the maximum benefit can accrue?
The Honorable Prime Minister has made this very important statement, and said a few years ago also about Make in India, and then we came to Heal in India. Now it is about marrying in India and holidaying in India. I think as Indians, we would be very good citizens if we followed his good advice, and that good advice would definitely help our sector.
Yes, the long and short of it. But tell me, your pipeline ambition, 100 plus hotels opening in the next 24 months, 255 hotels in the pipeline, keys in pipeline nearly matching operating keys of about 31,000 versus 33,000 earlier. That is an extraordinary aggressive expansion. What gives you this kind of confidence that demand will absorb this supply, especially when you're simultaneously flagging limited supply across cities as a tailwind?
Yeah, I think it's very important that the diversification of our portfolio and the brandscape is happening by brand, by geographies, and also by contract types. So all this demand that is exceeding supply is mainly in larger metros or absolutely new destinations where there is nothing. And the majority of the pipeline, not just of Indian hotels, but of the other companies, is also in the new, what you call tier 2, tier 3 markets, which are getting so many new airports, so many new highways, so many new CBDs. So I think that is in line with the market, and that is also being evidenced by all the reports. The consulting groups come on occupancies, on rates, on RevPAR, etc. So I think that is definitely one very important factor. Second, it's not just the Taj brand that we are growing. We are growing on our homestay front with Ama. We have the upscale, upper upscale, and the majority of our growth in terms of number of hotels is coming from the Ginger brand, followed by Gateway and then Tree of Life. So I think these kind of products, these kind of offerings are needed in the new modern and emerging India, where the middle class people also want to travel, also want to stay in hotels, and definitely everybody cannot afford the Taj. So there is something in our ecosystem for all kinds of customers, and now we are busy scaling that up so that we can address the needs and wants of this kind of relevant market segments in each kind of pricing point.
So if I could just probe you a little bit more about your acquisition strategy, because in FY26 you acquired controlling stakes in Atmanta and Bridge Hospitality, A&K, Pride Hospitality, and also onboarded the Claridge's collection. Now that's a lot of integration happening simultaneously. Tell me, what is the revenue contribution you're expecting from this bunch of new acquisitions?
Very good question again, Aisha. The first brand within our system, which we consolidated last year to have crossed a double-digit contribution to the total, is obviously our flight kitchen business, which is called TajSATS. So that is very strong for us. It's because it has a 60% almost market share of all meals served in the air in India. And save for a few dips here and there, I think this is going in a very strong way. The third brand to enter that in the next 12 to 16 months would be Ginger. Ginger, together with how we have clubbed it as new business, which is Ginger, Ama, Cumin, and Tree of Life, are also already contributing to double-digit growth to our top line at an enterprise level. So I think the way I see it is under Accelerate 2030, our traditional businesses, which is our absolute iconic Taj at luxury level, Vivanta, Gateway, and Selections, and Claridge's collection, would contribute approximately 70% of the top line, and 30% will come through all this new initiatives and newly reimagined Ginger, and we are on a very good way to it. Today we are already at, I would say it will be fair to say TajSATS plus new businesses already crossed 20%.
Well, that's great. But tell me, do you worry at all as to where the integration risk may be highest out of the bunch of new acquisitions and tie-ups?
Well, even if I worry, I'm not going to tell you on now that I get worried.
I was just trying my luck.
I think every challenge is an opportunity, and every opportunity brings challenges with it. So as you said, Ank Pride, we did that acquisition mainly to strengthen our Ginger brand. So 90 90% of that portfolio, when it migrates into Ginger, it will take Ginger to 260 odd hotels, as we can see today. So that would make it the largest mid-market brand. So we were already number one in luxury with Taj. Then you start heading mid-market. Then the next one we'll tackle is upscale. And we are also very pleased with Atmantan. I think that's been a phenomenal story. I never thought that with one property acquisition like Atmantan, it's talked about much more than anything else that we have done. So being in integrated wellness is really a very good customer value proposition that we have added to our business. And we are very, very pleased with the way that business is also running in terms of its margins. We think Atmantan can consistently deliver almost 50% EBITDA margin.
Well, that's fabulous. I hope there are many more wellness acquisitions lined up. But, I want to talk about your management fee as well. The management fee income grew about 22%. And this is the capital light engine that the market is most excited about. Now, with 4250 plus managed keys expected to open in FY27, walk us through what fee income could look like by the end of the fiscal. And is 20% plus fee growth rate a sustainable run rate?
Normally it is, Aisha. The only caveat here is how much the suffering in Dubai would be. We have 3 management contracts in Dubai. They were very rich in fees, or they are rich in fees, because you get these are dollar markets, and those fees, when they get converted into rupees, is a significant amount of money. Having said that, with or without Dubai, getting to another 20% plus year on a higher base is not something which we think is difficult. I think we should be easily able to achieve that, and that's a very important part of our strategy.
But tell me, Puneet, since you did talk about Ginger quite a few times, from what I look at, your Taj RevPAR grew about 10%, but Ginger grew only 5%. And that's a meaningful divergence that we're looking at here. Is this a demand story, premium travel outpacing budget, or is there a specific operational issue that Ginger needs addressing as you scale the brand higher?
Not really. This is an art and science of growth. If Ginger grows at 5 to 7%, because it is in district capitals, it's not just in Mumbai, or it's not just in Bangalore, Delhi, etc. If we look at those markets, the growth of Ginger RevPAR is also high, but it is also in Sanand, it is also in Kalinganagar, it's also in, other tier 2, tier 3 markets. But most importantly, when things go bad, the 10% could easily become 2 or 3%, but the 5% does not become minus 5%. That's the kind of positioning that you have, and the kind of resilience that you have in a mid-market like Ginger is very different. And in terms of upside also, as they say, high risk, high return, low risk, low return. The risk factor in a mid-market positioning with a brand like Ginger is lower. So the rate of increase of RevPAR will also not be exponential.
You're talking like a perfect equity analyst. So let me ask you one question from them, on their behalf rather. I want to talk about, your 2030 vision scorecard as well. Accelerate 2030. Now that's targeting 15,000 crore rupees in consolidated revenue and 20% ROCE. You're currently at about 9,689 crores in FY26. Now that means 55% revenue growth in 4 years. With the Middle East uncertainty and still a very big overhang, and perhaps a potential global slowdown as well, and supply additions from your competitors, what are the 2 or 3 variables that could derail that 2030 target for you?
Well, a geopolitical issue at a larger scale or a pandemic like COVID could derail, but otherwise, the health of the business is very strong. And very importantly, Aisha, which we have done and is very evident from our numbers, including last year and the year before that, we are spending more than 1,000 crores on a consolidated basis on CAPEX. If I was to include all management contracts, then that number is very large. So having done all those things on our own, actually, we are very well positioned to utilize our cash to actually add significant amount of assets to our top line, but only if they make sense. As I said, businesses which add either value to the brand or to the profitability, we would consider those, and we are in a very good position to do that without taking on debt. So I think that is the key, and our free cash flow that is being generated is more than 70% of the profit after tax. So I think all these things put together place us very well to either achieve or even overachieve the 15,000 target by 2030.
Hello and welcome. You're tuned into Mid-Cap Masala right here on ET Now, a show where we tell you what's all is happening within the mid-cap space and also get you the management voices. And firstly, let me welcome the management of Orientro on the show. We are being joined by Mr. Ashish Rai, who's the Vice Chairman and CEO of Orientro, joining us on the show. Hi Ashish, good morning and good to be speaking with you. And first up, Ashish, let's talk about your numbers then. And the numbers look quite good at this point in time. Help us understand what transpired, because though your revenue has seen a good jump of almost 45%, but there has been a pressure on your revenue and your EBIT margins as well. Help us understand what were the factors behind it.
Yeah, so first of all, morning and thanks for having me. Yeah, I mean, I would not sort of characterize it as good. I mean, by our own standards, I would say if I was to characterize the overall year, I would say it was below average. I think, we've been growing reasonably strongly, 30% plus for the last 4 years. So growing at 20% for the full year, I would say is muted. The way I would split it is first half of the year, fairly strong on expected lines. Second half of the year, I would say muted with some unexpected developments. So that's how I would sort of characterize the year. And mainly in Q4, the banking side especially, but the business overall, we bet quite heavily on Middle East as a growth driver for the business. And the war has had some effect, both in terms of deal conversions, where you've seen slowdown in decisions. It's not that the deals have gone away, but what we were expecting to convert in Q4 did not convert. And we've also had some issues in terms of putting people on the ground to deliver projects, right? So that slowed down further. So one was the Middle East. And the second is the data center side. I think we picked up an extremely large deal. And there's a slight mismatch between the need to make an investment in Q4 versus when the execution starts, which got delayed into Q1, right? Other than that, I would say the growth trajectory for the business remains strong. We've had very large deal wins on the transit side, very large deal wins on the data center side. We're rolling out a brand new banking AI stack. So the medium-term trajectory remains intact. For the full year, I would rate myself and how we did below average, but I think that those are temporary factors.
Ashish, thanks for being so candid on the show. Really appreciate the way you've put together your quarter four and the year gone by. This is Snehi also joining in the conversation. You did say that there were certain deals that you were trying to convert in quarter four that have now got pushed. On the back of this and the kind of base that we've seen in quarter four, do you reckon FY27 will be a better year for you than FY26? And how has quarter one already begun to shape up for you?
Yeah, so thanks, Nate. Great question. So like I said, right, I think the medium-term growth trajectory, we feel very positive about, right? So we feel transit, we built out one of the most competitive stacks in the world. We're winning really large deals like the 250 crore, MMRDA order that we announced earlier in the year last year. Data center, we become one of the prominent players in the space. Extremely strong relationships getting built up with the leading hyperscalers, so that business will continue to propel ahead. Banking and AI, we believe we have a very specific point of view on where the banks need to go, and increasingly we are at the center of it. We are rolling out a brand new stack. We launched a trade finance application a few weeks back now, which is the first fully native trade finance application, and we'll launch a whole series of applications from here, right? So feel very good about where the growth drivers in the business are and how we are executing against it. I would hesitate to really say anything concrete about where this year is. I feel we are well positioned, but there's obviously, it would be unfair to throw out a number out there given all the uncertainty, both the Middle East war, as well as a lot of other factors that we don't really control around supply chain disruptions, even on the data center side and all, right? So I would say optimistic on where the growth trajectory is, but I would hesitate to throw a number given, I don't think it's fair to throw a number given the uncertainty that we all know about.
All right. But Ashish, help us understand that what sort of a CAPEX are you planning for FY27, and especially with respect to the data center opportunity? How are you placing yourself?
Yeah, so data center for us is largely a services business where we are increasingly trying to move towards the product side, introduce our IP, but we will not get into any sort of a heavy capital deployment on that business. We will largely very capital light on that business. We work with hyperscalers. We run one of the top design shops in the country. We run one of the top implementation shops, but we won't put our own capital on the business, with the exception that we're pouring money into R&D to try and build products out into the space and move across the spectrum, right? So we'll increasingly be a larger player, but we'll be fairly capital light on that space. On the investments overall, this is the moment for us to really step up the investments, as we've been clear about the last couple of quarters. We feel we are ahead in terms of AI capabilities that especially the banking space needs, but overall the enterprise space needs. We have a very specific point of view on what the next generation of banking software should look like. And this is the time for us to really move with speed and build out. So we are undertaking a massive build program around the whole banking stack. And you'll see some of that in the last quarter, but also in the quarters to come. We'll continue to invest around data center products. We'll continue to invest around the hardware side as well. So we are a full atoms to bits player, right? So we work on the software stack, but we also work on the hardware stack on transits. We'll continue to invest there in terms of building out the hardware and systems capabilities as well, right? So plan fairly significant investments across each of those 3 areas for the next year.
So that sounds optimistic on the CAPEX front and how much you're looking to pour into the business. But Ashish, also talk to us about what this is going to do to your margins going ahead. Now, this quarter, of course, because of the reasons you've mentioned, margins have slipped slightly. But by when should we look at margins returning to your historic 20 to 22% levels? Or at least if you can give us any visibility on when we can once again cross the 20% threshold.
So for the actually, for the full year, we are still at 20% plus, barely, but 20.02 or something. So broadly, if you look at the year, right, EBITDA is, we said, between 20 and 21. It is between 20 and 21, towards the lower end, of course. PAT, we said between 15 and 16. It is at 15.02 again, or something like that. So at the lower end, but pretty much within the band. I feel as we move ahead, the main factor is the stepped up level of investments that we need to make right now to meet the moment we are in, which is very significant. You almost cannot sort of underemphasize the transformation that the banking stack especially is going through, but transit and data center spaces as well. So we have to step up investments to meet the moment. But overall, in terms of the margin trajectory, I think we've hovered around pretty much the same levels. I feel like we will try our best to sort of keep up at it. But even if there is some dips, those are temporary factors. Longer run, we feel very confident that each of our businesses is on a strong margin trajectory, and that should sort of overall improve as the operating leverage comes in and the scale comes in.
Right. And Ashish, on that note, lastly, what would that do to your book-to-bill ratio? Any number that you can share with us where it's right now versus where you are aiming for it to be?
Yeah, so look, we don't necessarily track it's a very, at least in my head, a very services-oriented metric, and we are fundamentally a product organization. So we don't really track it very actively. I feel what is really happening to the business overall is the scale of transactions that we are doing has increased, right? So if you, every year that gets stepped up. So, I mean, last year, if you look at it, we probably announced 4 or 5 different deals, which are north of 100 crores. If you go back the year before, there was only one deal, which is north of 100 crore, right? So I think the scale of transactions is going up. So if anything, the book to bill ratio will sort of go in the opposite direction, will actually get worse purely because you're booking much larger transactions. On the banking side, I would say the transaction sizes are still smaller, but on transit and data center space, it will only get bigger, right? What we feel is if you look at order book as a whole, if the order book stands at, let's say something in the range of 1,800 odd crores, almost 70% should be executable over the next 4 quarters. I think that's how I would sort of characterize it if you're looking for that metric.
All right, and we look forward to that. But Ashish, with this, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you.
All right, so that was the management of Orientro talking to us that what did not go well in the quarter gone by, but what can go well in the times ahead is something that he focused on. But with this, it's time now to slip into a very short break. Don't go anywhere. We'll be right back on the other side. Back with Midcap Masala. Before the break, we were interacting with the management of Orientro. Now let's focus and talk to yet another earnings candidate. It's the management of DB Corp that have joined us on the show. We have Mr. Girish Agarwal, the promoter director of DB Corp. Mr. Agarwal, hi, morning, and thank you for your time. I'm taking a look at your numbers, and they look like a fairly good set of numbers coming in. The revenue is up 5%. Margins have also expanded wonderfully for you, and the net profit has also seen about 19% growth. If you can help us understand what were the key drivers behind this outperformance that we've seen in Q4, and more importantly, is this kind of performance sustainable or even better? Is that something you're aiming for as we are now into FY27?
See, what happened last year, most of the categories, right from real estate, education, healthcare, all of them did a decent job, large single digit to mid double digit also, except the government, because what happened in the earlier year, we had the election advertising, Lok Sabha election advertising in that period. So because of that, there was, negative on that. That's the reason the overall performance, if you look at the whole year, was at flat. But if I remove the government, I was at 6%. Like in Q4, we were at 6%. And going forward, April has gone very well on a strong single double digit. So we believe this momentum should continue.
All right. Morning, Mr. Agarwal. This is Shrishti also joining in. But if we can talk some numbers with us, and especially EBITDA margin, yes, they have improved sharply despite the rising newsprint cost. But how much of the margin improvement was driven by operating leverage versus cost efficiencies? And can margin sustain at current levels if newsprint prices remain elevated over the next few quarters?
The last year, my overall margin, EBITDA margin was 26%. And with the newsprint prices, we believe in the first quarter, there will be at least 6 to 8% increase. And the Q2 should also be on the same side. But from the Q3, we believe major respite should come in because this war situation, what we are facing currently, will ease out, should ease out, and the prices should come down. So I think with that, if you look at the annualized margin, I'm pretty confident that what we did last year, we should be able to deliver that.
Okay. Mr. Agarwal, we've been hearing that newsprint prices have gone up by about 6 to 8%. Can you help us understand what the quantum is over here and how is this going to impact your profitability or let's say your overall financials over the next 2 quarters?
My 50% plus cost is newsprint cost. And if that goes up by, say, 6 to 8, 10%, the impact will straight away come onto the bottom line. So unless the advertising goes into a strong single digit or double digit, the impact will be seen. But I'm confident that looking at the overall situation, we should be able to maintain the margin what we have this year.
All right, good to know about it. But Mr. Agarwal, which sectors are currently driving the strongest advertising demand? And do you expect this momentum across the government and private advertisers to sustain in FY27?
So last year, or I would say in Q4, we had good performance by the education, FMCG, healthcare, real estate, and all that. And I don't see any major reason for them not to continue the growth. Jewelry may go down because of the recent announcement and the appeal for people not to buy the gold. But except that, I think most of the other categories should have the benefit. In fact, the people, those who will not buy the jewelry and gold, that money should go into other sectors. So I think the other sectors should see some growth on that.
All right, but also how should we look at the volume growth versus realization growth going ahead?
It's going to be largely volume driven. Realization is, I would say, a couple of percentages, but largely 80-90% will be the volume growth. Because in newspaper, we have advantage, unlike television channel, where you don't have anything beyond 24 hours, correct? In our case, we can expand the paper from 30 pages to 36 pages to 40 pages, depending on the added ratio we want to maintain.
Right. Okay. And Mr. Agarwal, I'm inclined to ask you, despite the structural concerns that we're seeing around print media and newspaper as a format to consume news, your company, DB Corp, has continued to deliver healthy growth. What key factors are helping the company outperform, and how are circulation trends shaping up across core Hindi-speaking markets?
Okay, so in Hindi and Gujarati, most of the market, we've been able to maintain the circulation largely, couple of percentages here and there. Now that clearly indicates that people want to read newspaper, provided you are able to provide the right content to them. And you just mentioned about some structural changes and all that. Frankly speaking, these kind of statement actually creates a confusion in the market. Why? Because structural changes happens when suddenly you see a large portion of the consumers going out. Couple of percentages here and there really can't call structural changes as such.
All right, point taken. But with this, Mr. Agarwal, we let you go.
Thank you.
So good having you on the channel today. Thank you so much for your time.
Thank you.
All right, so that was the management of DB Corp talking to us about what transpired in the quarter gone by, but he is positive on the volume growth going ahead. But for this, let's put the spotlight on Sirma SGS. The company did come out with its numbers. Don't look that great because the stock is also down almost 2.5% as we speak right now. But what's the outlook going ahead? Let's understand all of that with Mr. J.S. Gujral, who is the management of Sirma SGS, joining us on the show. Hi, very good morning, Mr. Gujral, and thank you so much for your time. And first up, when I look at your numbers, your Q4 revenue was slightly below the guidance, and that was a bit of a disappointment. Help us understand that what is the outlook going ahead? What led to that revenue miss, and even your margins? They actually exceeded, the EBITDA actually exceeded FY26 guidance, but what worked well for you on that front, and why there was a miss on the revenue front?
We normally take business on an analyzed basis, quarter on quarter. We don't do that. But specifically coming to Q4 of this financial year, you see there was a Middle East crisis, the logistics, the supply chain. These 3-4 issues coupled with a softening in the smart metering segment in India sort of led to this slightly lower revenue in the Q4 because we are a bit choosy about the customers. We would not like to chase revenue for the sake of revenue. Revenue plus cash in the bank. That's the matrix which we adapt. And wherever the customers or anything don't fall into those metrics, we try to stay away from that business. Now, my core business, which was profitable with the positive cash flows and all those things, they are on a very sound footing. And as you will see, while there's a slight softening at the top line, the margins have improved and cash flow has improved. We have delivered a 53% free cash flow of operating EBITDA. My working capital cycle has come down from 69 to 63 days. And if I was to exclude Alcom to compare apple to apple from 2 years, from 69 to 58 days. Based on the order book which we have got, we are very confident that going forward in the FY27, we should be able to give a 30% growth on 3 critical parameters, which is the revenue, EBITDA, and profits, PBT or PAT. So those are the three metrics which we would deliver on in FY27 as we have delivered in FY26.
Okay, so that sounds optimistic, Mr. Gujral. Help us understand that given the volatility in raw material prices, what level of pricing pass-through do you currently have with customers, and how should we think about the impact on margins and your working capital going ahead?
See, we have achieved the operating margin of 12% this year, 11 point some. We are guiding a 10% plus, 10 to 10.5% margin for the next year, primarily taking into account these volatility in the metal prices, the supply chain constraints, the logistic constraints because of the continuing conflict in the Middle East. As the quarter passes by, once there is a sort of stability returning to these markets, we would revise our guidance if it required at that point of time. But going forward, we believe that we are on track to give anything between 10.5% to 11% EBITDA margins in the current year.
All right, but along with that, Mr. Gujral, your export crossed 1,200 crores during FY26 and continued to grow strongly. Could you share which geographies and product categories were seen to be contributing the most to the export growth, and how meaningful could this India-EU FTA be for Sirma over the medium term?
You see, our exports have crossed the 1,200 crore mark in the current year, and the geographies primarily are Europe and North America. And the verticals are medtech, industrial, and little bit of automotive. Automotive exports for the first time this year, automotive electronic exports have crossed the 125 crore mark. We believe we are on track to increase the export revenues from the current level of 1,200 crores to about 1,500 crores going forward in the current year, which would represent about a 25% increase, 20-25% increase in the current year, 30%. So we should be crossing the 1,500 crore mark exports this year.
Okay, and Mr. Gujral, I'm just looking at your segmental performance. The industrial segment growth has been softer. What has led to this, and will this growth pick up in FY27?
See, the industrial segment in this quarter has been slightly soft, essentially because of the smart metering segment in the domestic market. My export industrial segment is going pretty strong. The smart energy metering segment is currently facing some volatility, and we are very choosy about the business and businesses which result into elongated cash flows. We try to avoid that. Having said that, for the coming year, my order book is about 6,500 crores, out of which industrial is about 25%. So I see the thing over a year stabilizing. We don't look businesses on a quarterly lens.
All right, but along with that, what is your current order book size? Can you please help us with the breakdown across various categories and segments?
See, my current order book is around 6,600 crores, 6,600 plus crores. And the breakup, automotive is about 29%, industrial about 25%, consumer 30%, IT and railways 10%, and healthcare and medtech 5%.
Okay, and also can you give us the contribution then that you're expecting from Elcom this year over FY27?
See, in FY26, Elcom has contributed approximately 171 crores to our revenue and about 52 odd crore rupees to our EBITDA. Going forward, we believe that in the current year, that is FY27, this 151 crores could go up to 270 odd crores, 270 to 80, and with the EBITDA of about 70 to 80 crores.
All right, but let's talk about your segments then, because automotive, industrial, healthcare and defense continue to gain share in the overall mix. How do you see the ideal portfolio mix evolving over the next 2 to 3 years?
See, these two verticals are the dominant, industrial and automotive. Medtech is small but growing. My Medtech business has registered a very healthy growth of 36% this year or FY25, and I expect in the current year it will continue to demonstrate that level of growth with high margins. Consumer, we are consciously restricting it to 30%, and if for a minute I was to exclude consumer from my portfolio, my growth has been 38%. Consumer grew by only about 8%, and that was a conscious decision. So the core verticals, which are high margin yielding, are intact and growing at a very healthy 25, 30, 35% growth. The automotive, for example, this year has grown by 39%, FY26, and I expect it to grow by around 30, 35% going forward.
Right. And Mr. Gujral, lastly, Sirma, SGS and Premier Energies, they've recently terminated the proposed K-Solar acquisition. Can you elaborate on some of the reasons why this deal fell through, and how does now what's your plan to build its presence in solar inverters and renewable energy?
See, we had signed off an agreement with K-Solar, Premier and Sirma to acquire K-Solar. There were certain conditions precedents which the seller was not able to fulfill, and hence we decided to call off that agreement. Now, this does not mean that we are abandoning the solar energy space. We are very much on track and in discussions with several technology partners to put up a greenfield project. So it's a slight hiccup in the whole plan, but I think in the coming quarter you would get to know, once we firm up the agreements with the technology partners. But renewable energy remains a focused area for future expansion.
All right, with this, Mr. Gujral, we let you go. So good having you on the channel today. Thank you so much for your time, and all the very best for the upcoming earnings. All right, but with this, viewers, before we wrap this edition of Midcap Masala, let's take a quick look what the markets are up to. So Nifty 50 is now seen to be flirting with the levels of 23,600. Let's see whether or not Nifty manages to hold on to that level. But pressure continues on Nifty Bank as well, which is trading below that 54,000 mark for itself. But yes, of course, the oil and gas counters, they continue to be, and especially the upstream companies, they continue to be the top gainers. ONGC is the top gainer with almost a 6.5% jump coming in on ONGC. Even Oil India is now up almost 9%. Other than that, the aluminium and the steel counters and metal counters, they are shining bright. Hindalco is one of the top gainers with almost 3% of gain, followed by Tata Steel, almost a 2% jump. But within the mid-cap space is the IT pack that is being hammered today. All the mid-cap IT companies, be it Persistent, Emphasis, Coforge, which was one of the star performers of recent times, that is under pressure. Let's see whether or not there is some recovery in the IT space. But with this, viewers, it's time to wrap this edition of Midcap Masala. It's a goodbye from me and Snehi and the entire team who put the show together. Thank you so much for tuning in.